the ground state today in terms of the range of assets that are supported and sort of the associated yields for lending against those assets? Maybe give us a sense of what that looks like today at Maple Finance and maybe how it evolves.
No, definitely can do that. Well, actually, one other thing I would add just on the metrics. The most important thing to look at on revenue for a lending business is what you call the net interest margin, or NIM. This is effectively what do we lend at and what do we lend out at and what do we have to pay for the funds that we borrow or take in. And so that's the other kind of margin that we look at. And for us, that's generally between, call it like 150 to 200 basis points on the loan book. The core asset in crypto-backed lending is of course Bitcoin. This is your kind of your hub, and then you have your spokes, which are going to be ideally other large cap assets. It's funny, as we were smaller, we did more bespoke collateral, like we would do Pendle PT tokens. We're still open to things like that. But now we actually have to think a lot more about how the collateral that we use scales. Like if we're going to do a piece of collateral that only allows us to do $5 to $10 million dollars worth of lending because it's newer or smaller in size, it's actually problematic for us because our loan book is growing so fast that we need to be looking at assets where we can do 50 or 100 mil in loans against them to really justify the time spent assessing them and putting them through due diligence. So if you look, the other assets that we are currently lending against, Solana, ETH, XRP, preferably, I think we're going to try and focus on things that are in the top 50. Rather than starting to go too far off piece. Because as I said, we're actually out the supply side of our market. So how much capital we have to lend out is growing faster than it has before. And so we just can't spend a lot of time on things where we can only lend 5 or 10 mil against it. So really top 50, most of it is anchored around Bitcoin. This is the asset that most lenders are comfortable with as well. And as I look at where the space is going, I also think it's the one where most institutional interest is going to be focused and directed as more TradFi firms start to come in.
And just out of curiosity, when you start talking about sort of rates, how much of that is being done as you guys underwrite sort of like what I'll call by you sort of more manually and on an idiosyncratic basis based on who you're lending to? And how much, if any, is being done algorithmically?
It's mostly being done by us bilaterally. We have calculators and tools that we use, and mostly you're going to base it on what the perps or a futures funding curve is telling you about the cost of the risk-free rate, so to speak. So if you look, Bitcoin-backed lending is going from anywhere from like 8 to 10% at the moment, annualized, and that would be 70% LTV loan, so 145% over-collateralized. And then as you look at the altcoins, they start to price higher. What happens though is that if you have a coin or an altcoin that has staking and a staking yield, you can actually price the loan lower because you'll collect the yield from staking the collateral. So like Solana was a great one for this, where you're able to price the loan actually lower or cheaper than Bitcoin-backed lending because you could keep the yield on the collateral. And then as you get into altcoin territory, when you get to sort of coins around the 50 to 100 range, you're probably looking at like 15, 16% on those types of loans. So it can be quite a wide range. And it's very reactive to macro sentiment. Like in March, the rate on Bitcoin-backed lending was down around 6 for a brief period of time, whereas in December, it was up around 12. So we went from 12 down to 6. Now we're back to like 8 to 10.
Got it. Yeah, so there's a lot going on in the sort of macro, and obviously the prices are very sensitive to that as well. So maybe let's talk a little bit more about the institutional borrowers in DeFi and to maybe dive into this. Maybe give the audience a sense of who are the typical borrowers on Maple Finance. And maybe even to go a bit deeper on that, you mentioned before, various, sort of borrowers come to Maple for different reasons in terms of why they want, to borrow. But maybe the like more common use cases that you're seeing from those borrowers for, why they're coming into the lending market.
I think the borrowers who come to Maple into the lending market in general, it's going to be a variety of reasons. So if you look at centralized exchanges and prime brokers, they're coming for leverage. They provide their customers with either margin trading or margin loans, and they want to borrow from a player like us so that they can make loans themselves at a higher rate. So you actually have kind of like a lending stack then. You have people that we borrow from, then the people that we lend to, and then their ultimate customers. And there's kind of borrowing on borrowing going on there. Then you have firms who might want it for OpEx reasons. So this could include a mining company who doesn't want to sell their crypto. They instead want to hold on to their Bitcoin. And so they borrow to pay for wages, equipment, electricity, that type of thing. And then you have high net worths and family offices. They're typically less frequently in the market. And what they might want to do is say, buy a house. You've got somebody who could have held crypto for 10 years now. They're thinking about buying a piece of real estate or some kind of lifestyle purchase. And so they're borrowing for a longer term use case, particularly if it's like a piece of real estate that they want to buy. And then you've got venture funds and liquid funds. They might have a position that they really like. They want to borrow against it and buy more of it. Or they might be doing a looping or a yield strategy on chain. So they've got something that an LP position that yields more than the cost of borrowing from us. And so they borrow from us and then increase that position and lever it up. But you can see the thing in common is that usually these are business or investment purposes that they borrow for. And I think over time, the number of different reasons people will borrow will increase as the space matures. But right now, it is very much focused on those reasons.
And sort of on the other side of the ledger, do you see any trends in sort of the institutional liquidity moving into the DeFi credit markets? Anything to report on there from sort of the front lines as you see it?
What we've seen is that there are more TradFi firms or firms that have historically not done that much with crypto looking to enter. I think the headline example and the most visible one would have been Cantor Fitzgerald announcing in July of last year that they wanted to enter Bitcoin-backed lending. And they've made a few announcements on it since then. This is a very well-respected broker and asset manager in Wall Street who's signaled that they see a profitable market or segment here. And then we've seen, not necessarily on the lending side, but on the trading and the brokerage side, folks like Charles Schwab, Morgan Stanley, different trading platforms have said that they will start to open up crypto trading for their users. And from there, once people start buying Bitcoin, the next thing they look at is, can they borrow against their Bitcoin, or can they get a yield lending against Bitcoin? Or can they get a yield on the Bitcoin itself? And that is one of the reasons that we added our Bitcoin yield product. But I would say this year, since the inauguration and since the what I would call the change in regulatory posture, it's now much more open to innovation and is very much set on making the US a leader in digital assets. The risk that you're underwriting as a traditional firm dealing with crypto has now dropped significantly. And so many more of them are kind of willing to enter the space. We've had conversations with a couple of traditional commercial banks around whether we could get a wholesale facility by posting Bitcoin as collateral. I wouldn't say any of them are near-term prospects, but even the fact that I can get a call with them is totally different from where we were last year.
It's really encouraging, and it's exciting to hear, especially when you start to hear about some of the bigger names that are, signaling that they're coming into the market in a really interesting and new way. Now, you've obviously been around the crypto space for a little while from a lending perspective. You've seen a lot of past market volatility. I'm very curious as to how you think about sort of risk management. Mm-hmm. Obviously, underwriting and sort of the stability around managing a loan book when we see this type of volatility is sort of, challenging to manage. And so I'm curious what you attribute, sort of the ability to, sort of manage sort of the high vol that, tends to take place in the crypto space as it relates to running a lending company. So how do you think about risk management and sort of the things you all do at Maple Finance to ensure what I would call stability in the face of a volatile asset class?
That's a good question. And the risk management of the volatile collateral is kind of the core or the bread and butter of what we have to do. So I'll use two different examples. So a very basic Bitcoin-backed loan would be a 70% LTV. So for every $100 of Bitcoin you give me, I give you $70 of loans. Now, the things I have to focus on are two triggers. So how much does Bitcoin have to drop before I'm asking you to send me more Bitcoin or to partially repay your loan? And then for how long do I give you to do that? And then from there, how long do I give you before I'm just selling your Bitcoin? And so for us, those two levels are the margin call level. Let's say at a 70% LTV loan, I'm doing a margin call at 80% LTV. So normally I would give you 12 hours, Alex, to then either post me more collateral or start to repay your loan. And then at 85, I'm just selling your Bitcoin. And then I have to sell it before I incur 15% slippage. So you can see I'm still leaving myself a relatively conservative buffer. It would be pretty unlikely for me to lose money in Bitcoin, like with Bitcoin collateral using those triggers. I would have to not be able to get the Bitcoin to an exchange or a market maker or not be able to monitor the price for a really long time to see those kind of movements. Then if you contrast that, so that's how we manage risk at a basic level. What do we set the margin call levels to? What do we set the initial LTV to? Because we have to size it appropriately to take into account the historical volatility. What I'm doing for Bitcoin, so if I do a 70% LTV loan for Bitcoin, I'm not going to do that for coin number 100 or 200.
Right.
Ideally, I'm staying away from coin number 200, but let's just use, for illustrative purposes, I would probably do an LTV at like 40% if I'm doing a more volatile token. So if I want to do XRP, I'm probably doing that at 40, 50% LTV, and I'm setting the margin call triggers tighter there. But it just gives me more room for more margin for protection. And it corresponds to the coin just having been more volatile over the last 24 months. But then we also look at where is it operationally supported? Like, can we go trade this? Can we go sell the position on an exchange? If we wanted to, this is why we kind of like the large caps, because they move billions of dollars a day. Whereas if I'm trading in a coin if I'm holding a coin as collateral that only trades $5 million a day, I'm never going to be able to get out of it to protect my position. So that's why we try and stay away from the smaller cap stuff. But that is the core of it, with a little bit of extra secondary emphasis on what's the rest of the party's balance sheet so that we know that they can top up collateral. Because you don't necessarily want to do a loan to a borrower where at the first sign of trouble, you're going to have to liquidate them because they're not going to be able to post collateral. It's not a good experience for them. It's not a good experience for us. And so we try and avoid that.